Net unrealized appreciation is a question I've received a couple times in the last week. So let's talk about that. Carl from Texas writes in, "Hey Josh, love your videos. I've learned a lot. I have not seen a video on NUA though. I'd be greatly interested in that one. Seems no one knows much about it around here. Thanks for all you do." All right, let's. Fidelity's got a good article on NUA, which I'm again one of the things I like about the brokerage firms, Fidelity, Vanguard, is they usually have pretty good stuff to get a good gauge on, which I'll use here today. But let me be clear. I have never, in all my years of financial planning, have we ever executed an NUA distribution, not one time. And I used to work with a lot of people over at ExxonMobil, right? Because USA had a big presence in Houston with some of those folks, not one time did we do it. Doesn't mean it doesn't happen. It just means for me, not one time did we did that. And the reason is simple, actually. We don't think in financial planning that you should have more than 10% of your liquid net worth in any individual security, not one. We don't think 10% should be in any one security, and that includes your employer stock, if not in particularly your employer stock. The reason for that is because if you, in this case, you got ExxonMobil as your company, ExxonMobil as your pension, and ExxonMobil as your 401k, which the bulk is in your stock. If ExxonMobil has some trying times, you are doomed. You lose your job, your pension could be problematic, and then, of course, your 401k is too. So for financial planning 101, when we saw big people with big positions in company stock, we didn't recommend that they kept that company stock simply because it's problematic. Now, it's up to them to keep it. A lot of these people have been at ExxonMobil and other firms for years and years and years and love it and love the company. It's like they're, freaking brother. And so telling them to sell it is like telling you to leave your brother, never talk to him again. They didn't want to hear it. But I'm just telling you, if anything, the dot-com bubble should have warned us not to have too much of your eggs in one basket. In fact, it's kind of funny because Merrill Lynch got killed with various options and NUA strategies back in the dot-com bubble when they're pulling money out of the 401k to take advantage of long-term capital gains, which never matriculated because this company went bankrupt. And so they're like, this. All right, so let's talk about how this works. All right, more than 15 million people own about 400 billion in company stock in Fidelity Administrative Workplace plans alone. If you own company stock in such a plan, there is a tax break that could save you a bundle on taxes. Anyone who owns company stock will eventually have to decide how to distribute those assets, typically when you retire or change employers. And going back to the Boeing example, so the Boeing VIP plan I talked about a few days ago, that Boeing stock fund qualifies for NUA, by the way. So if you have a lot of Boeing stock, this strategy would work. Taking a distribution could leave you facing a tax bill, but a little-known tax break dealing with NUA, net unrealized appreciation, has the potential to help. The tax treatment of NUA could be a significant break for an investor with sizable company stock holding, particularly if the assets have appreciated a great deal or if they plan to tap the funds in the short term. Of course, you don't want to let the taxes dictate investing decisions. Exactly. All right, so NUA is a difference between the price you pay initially for a stock, its cost basis, and its current market value. Say you buy a company stock in your plan for $20 a share, and you use $2,000 to purchase 100 shares. 5 years later, the shares are worth $35 each, so they have a total value at that point. Your 100 shares is worth $3,500. $20 your cost basis, $35 is your gain, is your new gain, is your new not cost basis market value. So you have a $15 net unrealized appreciation. Does that make sense? $20 cost, $35 market value. The difference is your NUA. So let's see. So in that case, your $1,500 in real terms would be your net unrealized appreciation. Why should you care about NUA? When you want to distribute a company stock or its cash value out of your 401k, you're going to face a choice: roll it to an IRA, or distribute the company stock into a taxable account and roll the remaining assets in an IRA. The latter option might be more effective depending on your circumstances. When you transfer most type of assets from a 401k plan to a taxable account, you pay income tax on their market value. But with a company stock, you pay income tax only on the cost basis, not on the amount it gained since you bought it. If you are under age of 59 and a half, you'll still pay the 10% penalty. When you sell your shares, you'll pay long-term capital gains on the stock's NUA. Today, the maximum capital gains rate is 20%, far lower than the 37% top income tax rate. In fact, capital gains rates will always be lower at today's tax rate, regardless of what your income tax rate is. The capital gains rate will be lower for sure. So your potential tax savings may be substantial. Now, to qualify for the NUA treatment, you must meet these 4 criteria. Distribute the entire vested balance in your plan within 1 tax year. You don't have to take the distributions all at the same time, but it has to be, you have to empty it out essentially. You must distribute all assets from qualified plans you hold with that employer, even if only one holds company stock. So you basically, again, you got to clean the entirety of the account out within 1 year. You must take distribution of stock as company shares. You may not convert them to cash before the distribution. So an in-kind transfer from your 401k into a brokerage account. And you must have separated from service, reached the age of 59 and a half, be disabled or deaf. The IRS enforces these rules strictly, blah, blah, blah. If you fail to distribute all assets within 1 tax year, your NUA election will be disqualified and you will owe ordinary income tax and penalty on the entire amount of the company stock distribution. All right, so let's talk about the example they have here, a case study. An executive in the 37% tax bracket decides to retire at age 50. She holds $100,000 worth of company stock with a cost basis of $20,000, resulting in an NUA of $80,000. I find that funny. So she's an executive in the 37% tax bracket, and she's going to retire, and she's still going to be in the 37% tax bracket. From where's her income coming from? Come on, that's what I'm saying. That's what we always. This is why it doesn't work. You're not diversified enough. And what's the likelihood when you leave your employer to retire, you're going to be in the same tax bracket? Nil. So that. All right, resulting in NUA of $80,000. All right, so let me just draw this out because for me, I need to see it, and we're going to show you how they draw it out. But for me, that's pretty busy. So I'll show you how they do it, and I'll show you how I do it. So she has $100,000 as the fair market value, of which $20,000 is CB, and $80,000 is her NUA. All right, so this is what we're looking at. Nice pink color. I thought that was red. It's actually pink. Perfect for Easter. $100,000 is fair market value, $20,000 is a cost basis, and $80,000 is her unrealized appreciation. She decides to distribute the assets to a taxable account. So it's all going to a taxable account, all right? And she decides to elect NUA treatment. She's going to pay income tax and a 10% penalty on just the $20,000 cost basis because the other amount is going to be done with the NUA. So she pays 10% early withdrawal penalty on the $20,000 of cost basis for a total of $9,400. Does that make sense? All right, actually, they'll show us here. So $20,000 the cost basis. She pays 37% income tax plus a 10% penalty on that cost basis. All right. She then immediately sells her company stock and pays a capital gain tax rate. So here, her NUA is $80,000. She sells it immediately and pays long-term capital gains at 20% as opposed to ordinary income tax at 37%. I challenge the idea that this would make any sense at all to do it while she still had a 37% tax bracket, but be it as it may, we'll run with Fidelity's numbers. In this case, her taxes and penalties are 25%, so she's going to lose a quarter of the portfolio for 10% penalty, income tax, and then net capital gain tax. But if she were to do it the traditional way, roll the whole thing over to an IRA and sell it, she'd pay 37% on that $100,000 and a 10% penalty on the entirety amount and pay $47,000 and essentially lose half. So in this case, she's making $21,000 more by not having to pay those extra 10% penalty on the entirety of the account plus a capital gain tax as opposed to ordinary income tax, the whole thing. My challenge is, and this is, going back, I've never done an NUA ever executed. We've looked at a bunch of them. It just never seems to work the way we anticipate. The reason is this is exactly what happens. The tax bracket never stays the same. It drops significantly. And so once it drops significantly, you're sitting there saying, is it really worth it for the NUA when I can just roll over to 401k and take it out as I need? And the answer is not. You can leave it in there tax deferred as a 50-year-old person and pull the money out as you need. Yeah, you will pay a 10% penalty for sure, but still it's just, I'm telling you, man, I have yet to find it. And this example probably is. If she needed $75,000 to buy her catamaran and she had no other assets, well, this would probably make sense. I'd still say, why are you losing 25% of the portfolio for the catamaran? That doesn't make sense. But each situation is unique. But the issue is I'd never found it to work ever in the scenarios I've dealt with. It doesn't mean it won't work for you. It just means a lot of people talk about this stuff and the history behind what we've seen with Merrill Lynch, with a tech bomb, with GE stock, all these various things. It doesn't work out the way we anticipate for most people. Well, I don't want to say most people, just my own experience. Anecdotal as it is, I haven't found too many people though in my business who have executed this, and I just haven't. So it's interesting to know. It could work. In this case, a perfect example of it working if she maintained her 37% tax bracket. Again, I highly suspect she would not maintain that 37% tax bracket. So what would we do anything differently? I don't know. We'd have to run that, but just keep it in the back of your mind. Anyway, something to think about. Just don't get too caught up in it. Certainly don't use this as your justification to keep one holding representing more than 10% of your portfolio. Way too risky, my friends. All right, we'll see you next time.